Okay, students, we're back, and I think I'm finished here talking about the statements. We've actually covered a lot of ground in our discussions there. So you will see as we move on down. Right here, there's something I mentioned earlier, and that's on the statement of cash flows. Cash means cash plus cash equivalents plus restricted cash. So if you take some cash and buy some cash equivalents, that doesn't even show up on the statement of cash flows because they are both considered cash. So it's literally like moving money from one pocket to the other. Now, if you sell some cash equivalents and have a gain or a loss, the gain or loss shows up in cash flows from operating activities. Okay. And there's a note from ExxonMobil from their financial statements. I'm not going to spend time on that. And they get into the primary elements. And again, we've talked about those already. One thing I do want you to understand when the FASB set out the statement of cash flows in FAS 95, it's kind of interesting how they defined operating activities, investing activities, and financing activities. They defined investing activities as involving transactions with long-term assets and short-term investments for companies other than those that are in the investing business. But generally, they defined investing activities that way. They defined financing activities as transactions with owners and creditors, excluding interest payments. And then they defined operating activities as all activities that are not investing or financing activities. So they made sure they didn't leave anything out. Then in the further explanation, they got into the discussion that operating activities generally involve transactions that are part of determining net income from operations. Okay, then fourth point they make here, even though they talk about the three primary activities, is the reconciliation of net increase or decrease in cash with the change in the balance of the cash account. And we looked at that. The indirect method does that as part of the statement of cash flows in calculating cash flows from operating activities. In the direct method, you have to provide that as a supplemental disclosure. Now, then number 5, non-cash investing and financing activities. Now, what that is if you go down and buy a piece of equipment, and rather than pay cash for it, you go to whoever is selling it and you sign a note with them. So it's kind of like you go to a car dealership to buy a car and you don't pay any cash, you just sign a note. So you drive out with the car. Well, technically, no cash changed hands at the time of the transaction. So the FASB defined that as a non-cash investing and financing activity. So that does not show up on the statement of cash flows as either a financing or an investing activity. Instead, it's reported as a supplemental disclosure, or it can be on the below the statement of cash flows on the face of the statement, but it's a separate category that's not calculated in with cash flows called non-cash investing and financing activities. And so you explain what happened, show the effect. Now, if on the other hand, you were to go down to your bank or credit union or somewhere like that and borrow money for them and go and buy the car. So you go and buy the car, and then your bank or your credit union sends a check or a wire transfer directly to the car dealership. And so you buy the car, then that gets treated as a financing activity in borrowing the money and an investing activity in buying the car. It shows up in both places. Now, I told you a while ago one of the dumbest things, maybe the dumbest thing the FASB has ever done, in my opinion, is their stated objective that the direct method is the preferred method. However, if you do the direct method, you also essentially have to do the indirect method as well. But if you do the indirect method, you don't have to do the direct method. But we want you to do the direct method. Well, that's pretty stupid. It's kind of like me telling you, well, you can do homework 1, but if you do homework 1, you also have to do homework 2. But if you just do homework 2, you don't have to do homework 1. Well, what are you going to do? Well, you're going to do homework 2, right? So that's a pretty stupid move. The FASB and the International Accounting Standards Board in recent years have made noise about requiring the direct method, though they have not moved to do that. Now, another stupid thing that the FASB has done is creating, in my opinion, creating this category of non-cash investing and financing activities. If you will remember, I've told you earlier in the semester that in accounting, the concept of substance over form is really important. And what that means is we account for the substance of a transaction, not the form of the transaction. If you go out and lease an asset, but you lease that asset such that you're using the entire useful life of that asset, then we account for it as a purchase, not as a lease. Because the substance of the transaction is that we bought the asset. The form of the transaction is we lease the asset. So we say we're going to account for the substance, not the form. Well, if you go to the bank and borrow money and use it to buy equipment, or if you go to the seller of the equipment and just sign a note with them, the substance of those two transactions is exactly the same. The substance is that you borrowed money and you bought an asset. So, in my opinion, those should be accounted for exactly the same way. And that would mean being reported on the statement of cash flows the same way. And the logical way to present those would be both an investing activity and a financing activity. But the FASB came up and said, well, we're going to pay attention to the form over the substance. So not really an intelligent way to do it from an accounting theory standpoint. But they didn't ask me. So I want you to understand that. Account for it the way it's required to be accounted for, not the way it should be accounted for. And the way it is required to be accounted for is those are treated differently, as I explained earlier. Okay, so move on down, and again, they get into cash flow from operating activities. The relationship between net income and cash flow from operating activities. This is the direct method, and so they, again, walk you through that. You know, what do we do on the income statement? We report sales and service revenue. On the statement of cash flows, we want to show cash received from customers under the direct method. Investment revenue, we want to show the cash revenue received. Now, investment revenue might be different from cash received because of the amortization of a premium or discount. So we move on down through these. I have shown you those, explained them. I'm not going to cover them more here. I'll show you a little more here in a minute. Now, again, there they show you the cash flows from operating activities under the direct method. And here they talk a little bit about the difference between the direct method and the indirect method. And again, I've already explained that. I hope y'all understand it. So I'm going to move on, but you can look at this as long as you need to make sure you understand it. Okay. Now, right here, they talk about what I've talked about earlier, whether cash flows from operating activities are reported by the direct method or by the indirect method, financial statements must reconcile the difference between net income and cash flows from operating activities. Now, when the company uses the direct method, the company presents the reconciliation in a separate schedule, as we saw a minute ago. That presentation is precisely the same as the presentation of net cash flows from operating activities by the indirect method. On the other hand, a company choosing to use the indirect method is not required to provide a separate reconciliation schedule because the cash flows from operating activities section, the statement of cash flows, serves that purpose. And they make the point there, most companies use the indirect method. Now again, if you're wondering what percentage, that percentage is about 99%. Out of a survey of 500 companies, only 5 use the direct method. Okay, we have some homework, so let's look at those. We'll cover a few of these before our time runs out. So here is brief exercise 21-1. Horton Housewares accounts receivable decreased during the year by $5 million. What is the amount of cash Horton received from customers during the reporting period if its sales were $33 million? Prepare a summary entry that represents a net effect of the selling and collecting activities during the reporting period. Okay. So accounts receivable decreased during the year by $5 million. What does that mean? Well, it means more was taken out of accounts receivable than was put into accounts receivable. We put into accounts receivable through sales. So we added $33 million to accounts receivable. How much did we take out if accounts receivable decreased by $5 million? Well, let's just pretend that the beginning balance of accounts receivable was $5 million and the ending balance was 0. So what does that mean? Well, it means we had $33 million in sales, or we added $33 million. So that would have gotten us up to a balance of $38 million. Ending balance in accounts receivable is 0. So how much did we collect? Well, we received from customers $38 million to get that decrease in accounts receivable. So here you see cash received from customers. We had a credit to accounts receivable and a credit to sales, so we needed to receive cash to cover both of those of $38 million. Okay, let's move to the next one. April Wood Products accounts receivable increased during the year by $4 million. What is the amount of cash April Woods received from customers during the reporting period if its sales were $44 million? Again, prepare a summary entry that represents the net effect of the selling and collecting activities during the reporting period. Well, we had a credit of $44 million to sales revenue, right? And then we had an increase of $4 million to accounts receivable. So that's going to be a debit to accounts receivable. Now, again, the way you have to think through this, the way accounts receivable went up was we had more in sales than we had in collections. So if we have a credit for $44 million and a debit for $4 million, we need a debit of $40 million to cash to reconcile that. So cash received from customers is $40 million. Okay, we will stop there and I'll pick up with the next homework problem on the next video.